markets drop and headlines get loud, most people feel the same thing: anxiety. You check your portfolio more often, you wonder if you should sell, move to cash, or just wait it out. And deep down, there's that question: am I doing the right thing, or am I making a mistake I'll regret later? Here's the truth: market downturns are inevitable. They're not a surprise, they're part of the cycle. But what do you do during these downturns? That's what determines whether your plan succeeds or starts to unravel. Because in times like these, the people who stay calm aren't lucky, they're prepared. They have a plan that tells them what to do, when to adjust, and when to stay the course. And the biggest advantage? It's not timing the markets. It's not panicking when others do. If you're in your 50s or 60s or already retired and you're wondering what to do with your investments when markets fall, this is the moment that separates guesswork from strategy. Hey there, I'm David Drummond, founding partner at DLD Financial Group Ltd. We help Canadians simplify retirement, reduce tax, and build income plans that hold up, even when markets don't. And in this video, I'm going to walk you through what not to do when markets drop, how to keep your investments aligned with your long-term plan, and the steps we take with clients to protect income, manage risk, and stay focused even when volatility hits. Because it's not about reacting to markets, it's about having a structure that lets you move forward with confidence, no matter what the headlines say. And if you find this helpful, don't forget to like, comment, and subscribe. It helps more Canadians access advice that's grounded, practical, and built for real life. Let's get started. Part 1, the most common mistakes people make during market drops. When markets fall, it's natural to feel uneasy, especially if you're close to retirement or already drawing income from your portfolio. But in times like this, the biggest danger isn't the market itself, it's how you react to it. Let's walk through the most common mistakes. Panic selling is number 1. This is the most obvious and most damaging mistake. When portfolios drop, people get scared. They move everything to cash thinking they're playing it safe. But here's what that really means. You lock in your losses, you miss the recovery, and you often buy back in too late. After prices have already rebounded, the market doesn't need your emotions, it needs your plan. Number 2, changing your strategy midstream. Your portfolio should be based on your time horizon, income needs, and risk tolerance, not headlines. But when markets drop, many investors suddenly shift from long-term growth to short-term fear. They want to change everything: asset mix, allocations, and even advisors. That kind of reaction often leads to permanent damage from temporary problems. If your plan was built to last through market cycles, now is the time to trust it. Number 3, stop contributing or withdrawing. Without a plan, we've seen people stop investing when prices are down, even though it's one of the best times to buy. Others stop drawing income, afraid to touch their investments. Both responses come from fear, not strategy. And in reality, a well-structured plan gives you options. You don't have to guess. You just need to know where your income will come from and which assets are designed to handle short-term pressure. Number 4, forgetting that losses and risk are not the same. Just because your portfolio is down doesn't mean you've taken on too much risk. Risk is when your money is exposed to a level of volatility or loss that threatens your plan. A temporary decline in value, when expected and accounted for, is just part of investing. If you've designed your retirement income properly, market drops don't have to derail your future. Markets fall, plans shouldn't. This is where structure matters most, more than headlines, and staying disciplined matters more than being right. The good news, with the right approach, you can manage downturns without fear and come out stronger on the other side. Part 2, what should you do instead? Smart moves during volatility. When markets drop, your first instinct might be to take action, to do something, and that's not wrong, but the key is doing the right things. Moves that are grounded in strategy, not emotion. Here are 5 smart actions we help clients take when markets turn volatile. Number 1, zoom out. Revisit your long-term plan and start with a perspective. Look at your goals, your income needs, and the purpose of your portfolio. Ask, am I still on track for my retirement income goals? Do I have a clear strategy for where my withdrawals are coming from? Has anything changed in my life, not just in the market? If the answer is no, this may not be a time to change your plan. It may be time to trust your plan. Number 2, rebalance. Don't react. Market declines often throw your portfolio out of balance. If your equities have dropped, your fixed income allocation may now be overweight. This causes a natural opportunity to rebalance, buying quality investments at lower prices while keeping your risk in line. We don't abandon the strategy, we bring it back into alignment with purpose. Number 3, use a bucket strategy for peace of mind. This is one of the most effective tools for retirement income planning. With a bucket strategy, your portfolio is divided into segments. Bucket 1, 2 years of income in cash or stable assets. Bucket 2, 3 to 5 years in low to mid-risk investments. Number 3, long-term growth in equities or diversified portfolios. When markets drop, you're not forced to sell from bucket 3. You draw from buckets 1 or 2, giving your assets time to recover. This protects your withdrawals and your peace of mind. Number 4, harvesting tax losses strategically. In non-registered accounts, a market drop can create opportunity to harvest capital losses. You can sell investments that are temporarily down, use the losses to offset gains, and reinvest in a similar position to stay on strategy. It's a way to turn short-term volatility into long-term tax savings. This is something we coordinate closely with clients' tax advisors, and it can be especially useful for high net worth families. Number 5, keep contributing. If you're still working, if you're still earning income and saving into your RSP or TFSA, keep it going. Market declines mean you're buying at a discount. It's one of the only times where people panic when the store puts everything on sale, but the investors who keep contributing during downturns are often the ones with the strongest recoveries. Downturns are part of the journey, but when your plan is structured and your behavior is aligned with your goals, a market dip becomes a manageable event, not a financial crisis. This is where real planning earns its value. Part 3, how to protect your retirement income through any market. When you're retired or getting close, market downturns feel different. It's no longer about riding it out for 30 years. It's about having enough income this year, next year, and every year thereafter. So the question becomes, how do you protect your income even when markets drop? Here's how we help clients do it without relying on guesswork or luck. Number 1, have a defined withdrawal strategy. Retirement income isn't just about which accounts you have, it's about how you draw from them. A smart withdrawal strategy coordinates RSPs and RIF withdrawals, TFSA top-ups, corporate income or dividends, and timing around CPP and OAS. In a downturn, we often adjust the order or source of income, not the total lifestyle. This keeps the plan stable while giving investments time to recover. Number 2, separate cash flow from market volatility. This is where the income floor or the bucket system really shines. We build portfolios where your near-term income is not dependent on market returns. That way, you're not forced to sell equities when they're temporarily down. You keep drawing your retirement income calmly and consistently, while the growth side of your portfolio is left to rebound. Number 3, build flexibility into your spending plan. A strong retirement plan isn't rigid, it's flexible. We work with clients to identify core spending versus lifestyle extras. Essentials like housing, healthcare, groceries. These are protected with guaranteed or stable income sources. Discretionary spending like travel or gifts that can flex year to year based on market performance. That way, you're never forced to cut back on what matters, and you stay in control even when markets aren't. Number 4, stress test your plan. Before the drop happens, the best time to prepare for a downturn is before the downturn. We stress test every retirement plan we build, asking, what happens if markets drop 20% in year 1? How long will your income last in that scenario? What adjustments are built in? When you've seen the worst case scenario in advance and still have a clear path forward, market volatility becomes a known risk, not a panic trigger. Remember that retirement isn't a one-year plan. If you retire at 60 or 65, your plan could last 30 or more years. A bad year or 2 doesn't define your outcome. Your structure does. We build portfolios and income plans designed to withstand full market cycles, not just good times. Because the goal isn't just to survive a market drop, it's to retire with confidence in every phase of the market. Part 4, long-term mindset. When markets drop, it's easy to feel like everything's off track. But here's what we remind our clients. The market doesn't determine your retirement success. Your plan does. Volatility is a feature of investing, not a flaw. And if you've built a strategy designed to withstand the ups and downs, these moments don't require a reaction. They just require reassurance that your plan is still doing its job. The people who come through downturns stronger aren't the ones with the best timing. They're the ones with a clear strategy, a steady mindset, and a team guiding them forward. So if you're in your 50s or 60s and you've built up real savings, $500,000 or $1 million or more, but you're unsure how your portfolio would hold up in a real downturn, now's the time to find out. Book a free retirement strategy call with our team. We'll walk you through how to protect your income in any market, where your current risks and tax traps may be hiding, and how to build a retirement plan that delivers peace of mind, not just when things are good, but especially when they're not. Click on the link below to get started. And if you found this video helpful, please be sure to like, comment, and subscribe. It helps more Canadians retire with clarity, confidence, and fewer surprises. Thanks again for watching, and I'll see you in the next video. Take care.